Welcome back to Golden Rule Radio, your weekly recap of the precious metals markets and the markets related to the precious metals. And for the chart guru, as always, I'm going to pass this on over to you, Miles. We haven't had a week without volatility, that's for sure, but we've also had a week of some stability and encouragement. Show us what's going on.
Yeah, Tori, we're definitely seeing a bounce back up in a lot of things. The precious metals have bounced back up, and we'll dig into the gold chart here. The equities markets have bounced back up. The dollar has come back down. So we are seeing that interplay between the markets as we're seeing little bounces here amidst catastrophe, the eye of the storm, so to speak. But starting off with the gold charts, gold has taken a little bit of a bounce back up, but did it ever really come down? I mean, let's be honest here. We're talking about going back to August, gold at around 1680, pushing up to 2080 by March of this year. That's a $400 rise in 7 months, if anybody's doing the math there. And a pretty healthy correction back down. I mean, we did look at this last week, coming back down all the way sub 1800, and we bounced back up to the mid 1800s. So on the medium term charts, I know I talk about my different terms, but looking at the medium term charts, that 1680 was at the 618 fib, which puts our 382 fib, which we are now above and looks like possibly climbing above at around 1828. So I'm not quite bought in yet that gold is getting ready for that next push up. I think you're going to continue to see gold trade within this couple $100 range, 18, 19, 2000, somewhere in that range. We could even see another little push down, but do I think gold has any prayer of ever going below 1680 again? Of course not. So the question is really just how long do we continue to languish in this growth period as gold has continued to put in higher lows since August? It looks very strong on the long term. And as long as we're stretching our camera back a little bit and looking at the entire forest, gold remains the hedge that it's meant to be in major financial crisis, which we'll look at here when we talk about the equities decline that we've seen since the beginning of the year.
Okay, great. So what about silver? Are we following suit there? I will say that the gold-silver ratio has contracted a bit over the last few weeks after topping at 88 and coming back down to about 84. So that would tell you that silver's kind of outperformed. But what are you seeing chart-wise for silver?
So from a charting perspective, I actually have the opposite opinion. I think silver is inclined to maybe take one more decent step down. We've had a lower high and a lower low. Now, eventually, one of those lower lows kicks off the next growth phase. So I do understand that something ends up being the bottom, but I tend to err on the side of caution when it comes to charting, and I like confirmation, and thus far, we've had no bullish confirmation in the short term in silver. Also, silver just hasn't really gone down. Silver really hasn't taken the correction it needs to
in what
based
period
on
of time?
Where it started. Going back to when silver started climbing, like 2017, 2018.
Okay.
And then obviously the big jump up back in March, April of 2020.
2020, right.
Yeah.
So we had a big run. And then obviously later in that year of 2020, we exceeded the $30 mark. And I ask you that question being sensitive to the clients that have watched silver decline from essentially 31 to 21.
Right.
That's a big drop.
That.
But we're far away from the $11 where we started in 2020.
Yeah, it's a big drop, but it's relative.
Gotcha.
And being somebody who looks at the long-term charts, dollars don't mean anything to me. I care about ounces, and I care about percentages. So like you're bringing up, it is a fair point. What I'm looking at is where am I dollar cost averaging in on my silver positions? Because I know, because I know what you just pointed out is the trading range is enormous. You're talking about a $10 range. So I did send a chart yesterday, which I'll throw up here, just showing kind of where I think the rungs on the ladder are, my entry points or my breakout points I'm looking for on silver. I would like to see silver take one nice healthy step down just below $20, maybe in the 1960 to 1990 range. So I'm not talking about silver going back to like 14. I think that we are closing in on the end where we're going to see a turn back up and possibly retest at least 26 if not the old 30, 31, and that's going to take a couple months. Well, what's a couple months from now? We're out of summer. We're out of sell in May and go away. It's over at that point, and fall tends to be incredibly strong for the metals as a general rule, which we've talked about in years past. So I would like to see silver maybe take a little double bottom here, some RSI divergence, slightly lower low than what we put in here end of April, beginning of May. 1960, $20 turnaround, and then I think 26 is just a couple skips away, and we get above 26, we're back at 30, we get above 30, and gold's already broken through its previous all-time highs, and silver's got a long way to go. So for me, I'm still looking at dollar costing into silver, and I think everybody should be. I'm buying at 1960. I'm buying at 2190. Guess where we're at today that you just brought up a second ago. I'm buying when we get to 26. I don't mind paying $5 more if I know it's on the way up. But I'd also like to pay 50 cents less, too, if I get the chance to.
Well, I think you might. There is the old adage, buy in the summer, sell in the winter when it comes to the physical precious metals. We're entering into that time of year, May being one of the months, along with June and July, where we'll often put a low in, just from a seasonal trend standpoint. Don't be discouraged, because you also have to remember we have 2 more rate hikes to absorb in the coming months. They've talked about, from a Fed standpoint, with Fed lending rate, another 0.5 point hike, likely 2 in the next 3 months. So that's okay. If all stays quiet on this Western front, we're acquiring ounces, we're waiting patiently, and that is going to impact the white metals. But where else would you rather be right now than gold and silver? You've got the NASDAQ down 27%. The S&P also hit bear territory, down 20% year to date. Would you rather be in Bitcoin? I don't think so. Would you rather be in the US dollar, losing 1.4% every month? That's what your cash is doing. It's just getting robbed every month. And so not a whole lot of excitement in the metals prices, but holding steady, holding firm compared to those significant drops in other markets. I will absolutely take it, knowing that it's just a temporary little reprieve here. So, Miles, we do need to get into platinum and palladium.
Yeah, that's somewhere I'd like to be, since you asked. Platinum hard stuck at 909 looks really good to me. We've been bouncing between that 618 fib at 909. We've hit it 3 times. We saw a little bit of a ceiling at the 50% line about 991. So we've had this like $80 range in platinum since the last time we hit it. So still pressing down. So the argument, at least very short term meaning over the last 6-8 weeks, obviously bearish in platinum, but we've got a pretty defined floor that's going to take a lot of fullback strength to blow through that defensive line, and we'll see if the bulls can hold strong there. So platinum is one of those places I'd like to be. Housing is definitely not.
No, there's another category. Thanks for bringing up
well,
another
there's
one.
another. Yeah, I'm surprised you didn't bring that one up. I think I looked at the housing sector chart down 29%, and that actually kicked off before interest rates started going up. And that's the part that's interesting to me.
Yeah, I think that's why it's a convenient time to raise rates.
Right?
If the housing starts to roll over, you can certainly create a larger snowball in quicker fashion, but it was baked in already, so go ahead.
So you look at the Fed funds rate, which starts going up at the beginning of 2022, but the anticipation of that, I think, is what matters here, because the equities market began falling in December previously. The housing market, the 30-year fixed mortgage rate, started going up in August of last year in anticipation of it. So I think it's important to recognize that it's not just reactionary. There's also anticipatory moves in the markets. And I think what we could be seeing is a reactionary rebound in the equities market right now, which is obvious. I mean, the NASDAQ was down 31%, the industrial 17%, the transports 27%, the S&P 21%, housing sector 29%. That's a lot of down in 4 months. You're going to have bounces. But a lot of that began before the Fed funds rate started going up. And like you just said a second ago, there's at least 2 more interest rate rises this year and a tightening of the Fed balance sheet. Nothing looks good for equities into the future, and the market is starting to recognize that.
Yeah, they're pricing in recessions, and everybody's getting ready for that. You talk about anticipatory moves. Are the metals kind of anticipating that commodities peak or an inflation peak? We don't know yet. If you're watching oil and natural gas, they haven't peaked yet. Natural gas just hit $9 for the first time since 2008. That's incredible. Oil is obviously firmly over 100. So those are things that tell us that tough times are here to remain because everything centers around energy. It's not just renewables that get all the attention. It's the fossil fuels, if you will, that drive the economies from transport. You've talked a lot in the last few weeks about the transports, the price of diesel, the price of gas, the price of manufacturing, the PPI. All of those things are putting a lot of downward pressure on the economy. And that being said, the economics would certainly dictate that the equities would respond accordingly, and that's what we're seeing happen. Hold your positions, add to your ounces here, and again, take this as an opportunity to encourage yourself on your hedge.
So that's going to do it this week for Golden Rule Radio. As always, we appreciate you stopping by. If you liked what you heard, hit the subscribe button, ring the bell. You can find more info on our website at McElvaney.com. We're also on Twitter at ICA Gold or Facebook at McElvaney Financial. If you'd like to discuss your personal portfolio with one of the advisors here at McElvaney ICA, you can give us a call at 800-525-9556.
Thanks for listening. Have a great week.